Okay, good morning to everyone. Today is the 4th of December, and we're entering really the last phase of the course here. So we're in week 14 right now, and I'm going to cover some more with regard to shareholders' equity today in chapter 13, talk a bit more about issues concerning the stock, the capitalization element of a firm itself, and we'll talk a bit about stock buybacks and all that. And so the due dates were originally scheduled for obviously last Sunday, but I moved that to 12/7. And I do want to talk a bit about here at the outset some of the due dates because we're really sort of very close to the end. And I want to talk about what's happening here. So chapter 18 quiz and homework, I sort of deferred to this Sunday. And, so you got some time to work on that. One thing I'll say about this is if you need more time to do this, just let me know. Just send me an email saying, hey, I need a little more time. I don't really need an explanation or whatever. Just if you need more time, I'm happy to do it. Hopefully I've sort of communicated this to students over this semester. But I really like to give people more time to do things as opposed to less. It does sort of add stress on me, but that's not really a consideration. I'd rather have you have more time to do things. So if you want to get it done by this Sunday, that's fine. Hopefully you do. And if you need a little more time, just let me know. But I do have to reset things. That's what really is the key issue here. I have to reset things in Connect and also in Brightspace. And so just let me know if that's the case. It's no big deal. And I can do it. One of the things about sort of deferring some of these is that sometimes people get the wrong idea and think that I'm trying to push everything toward the very end. And really, I'm trying to give you more time. If you want to, it's really up to you to sort of budget how you want to allocate your time in order to accomplish, the chapter 18 homework and quiz. But we also have an exam. I'll talk about it before we leave today. A bit about what's to be expected. It's not all that different from exam 1. It's different from exam 2, but we'll talk a bit about that. And then next week, my plan is, because I don't think really I'm going to be able to get all the way through the rest of the content in chapter 18 today. So I'll cover that on Tuesday. And you may be thinking, well, wait a minute, why are we covering chapter 18 on Tuesday when the work was due on Sunday the 7th? In other words, why on 12/9 are we talking about something that was due on 12/7? Well, first of all, the final exam is comprehensive, so it's going to cover all that material. And I really don't think we're going to have that much more to sort of, cover, maybe, just a little bit more and go from there. Thursday of next week, what I want to do is sort of have an open class session where you can show up personally if you want. I know that physical attendance has not been a real feature of this particular section. We've had a few people show up, but not many. But if you want to come and show up, that's fine. Or simply log into Zoom and ask questions. It's really a Q&A session for you to answer or to ask any questions you've got, because the final exam is up and running, or will be up and running on I think Friday actually, and Friday at 8 a.m. And so if there are things that are lingering out there, and look, I know intermediate accounting is not the easiest course out there. Believe me, I've now got something like 250 college credits, and so I understand this is not the easiest course at all. So if you have questions about this, about anything that's going on here, show up, and just ask questions and whatnot. I'll be available, and if you want to get with me outside of the class session during office hours, that's fine too. And I'm more than glad to help you out. So that's really what's going on. So we're about toward the end here of the semester, and so any questions? Anybody in the classroom or whatever? Any questions? All right, so we're talking about chapter 18. So let's kind of pick up from where we left off last time. So remember, and I've said this a gazillion times before, but when we talk about intermediate accounting, I think what it really is a sort of a deep dive into the financial statements that the firm prepares. There are 4 main statements, obviously: balance sheet, income statement, statement of retained earnings, and cash flow statement. The cash flow statement, for those of you who are going to take intermediate 2, you'll do a deeper dive into that. That's something that's a little bit trickier, but it's interesting, and you'll get to that. Probably also the statement of retained earnings, which has a number of different names over time. Statement of changes in financial position is what it's been called over time. Statement of changes in owner's equity and whatnot, but it is what it is. It's simply the change in the equity position of the company. But here, what we're doing is, and probably also the income statement, you'll cover that in more detail. Here, we spend a lot of time on the balance sheet. And in a lot of ways, and I've known lots and lots of accountants over the years who, when asked which is the most important statement of all, will sort of default to the idea that balance sheet as being the most important statement. It's arguable. I don't know that there's a right answer. It's subjective and whatnot, but I do think that of the two most important statements are very clearly the balance sheet and income statement. No question about it. So, and the balance sheet, whether or not you believe it's the most important or not, is nonetheless an extremely important statement because it reflects what we call the statement of financial position of the company at a given point in time. In other words, we take a picture, we snapshot it as of December 31st or March 31st or whatever the cutoff period is for our bringing things current after we do adjusting entries and all this good stuff and bring things current. This is what the firm looks like. And this is really what we're doing here in Chapter 18 is covering the rest of this. Moving over to what we call the equity side of the statement, and that is dealing with shareholders' equity. So let's get where we left off last time, talking about where we left off. And we were talking about stock, and I believe this is where we left off. This is at least how I sort of flagged my notes. Remember, when we talk about the stock of a company, and we're talking about capital stock issued to issued by publicly traded companies to whoever wants to buy these shares, right? So we have common stock and preferred stock. As I mentioned on Tuesday, common does not necessarily imply that it's of a lesser hierarchy than preferred. In fact, if you're trying to acquire ownership of a company, common stock is what you want to have. Not all companies have preferred shares. In fact, I think the minority of companies have preferred shares. But preferred stock is sort of an interesting sort of hybrid security. And that is the idea that it combines the elements of ownership, because it's an equity security, with the more or less implied guarantee of an income stream like a bond in that case. And also in liquidation, preferred shareholders have preference in terms of being paid out as opposed to common shareholders. We talked a bit about that on Tuesday. So when we talk about preferred shares, we're really talking about sort of a hybrid. In my mind, I've long thought of preferred shares as being more akin to bond investments than stock investments in a lot of ways. It has a fixed interest rate, and it's more or less guaranteed. I don't know that I can point to too many examples in which companies have not made good on preferred dividends. They issue them because they expect to be paying them, and to the investor, they are taxed these dividends. That is, on the other side of the transaction, those who are investing in these shares pay tax at the lower preferred dividend tax rate, which is lower typically than the ordinary rate, especially for high earners who have higher marginal tax rates. So what are the rights of preferred shareholders, and why would anybody want to own a preferred share? Even though the term preferred sounds like it's, again, the major leagues as opposed to common being the minor leagues, that's not really the case. And so let's kind of disabuse ourselves of that notion. But nonetheless, why would an investor want to own these shares? Okay. So number one, the rights are, if the board of directors declares a dividend, it is the directorship. Remember, we're talking about publicly traded companies that have a board of directors. And so if there's a dividend declaration, preferred shareholders are first in line in order to get to that before any dividends are paid to common shareholders. And so whatever the dividend that's being declared is, it's going to go to preferred shareholders first, and then whatever is left over is going to common shareholders. And I know that sometimes accounting textbooks have this idea that, we're going to declare $1 million dividends and 800,000 is going to preferred shareholders, and so therefore the scraps are left to common shareholders. It's not quite the idea, because I think boards of directors know what they're doing, and they are aware of what's going to preferred and what's going to common shareholders, and they will adjust their payment, their dividend payments accordingly. And in fact, dividend policy is an important piece of corporate management at the very high levels. And something we don't cover a lot here in this course, but dividend policy, the idea of sometimes being consistent to common shareholders is a real virtue. And when companies are not consistent, it's sort of disconcerting to those who own shares, because they really have no idea what sort of income stream they can expect in the form of dividend payments. And so So it's not like, okay, here's the amount, and we're going to sort of preferred shareholders, and the scraps go to common shareholders. It's not quite like that, but definitely in legal terms, in terms of preference, preferred shareholders get first dibs on that amount that's being paid out. Okay, and common shareholders may get nothing. And by the way, there are lots and lots of common shareholders who will get paid nothing anyway because there is no dividend being paid to them. And particularly in the technology world, dividends are sort of a scarce commodity, and investors don't really care about the dividends so much because these are companies that are growing earnings tremendously, reinvesting earnings, what we call recapitalization, and making more and more money. And so it's not really all that much of an objective. But for those who do rely upon dividends, preferred offer a much more reliable stream of income coming to them from the company in which they're buying shares. And again, not all companies offer preferred shares. We tend to see it sort of concentrated in the financial companies. If you look at a company like JP Morgan Chase, which has a number of different classes of preferred shares, that's one example among many, I will admit, companies that issue preferred stock. And it's sort of a hybrid between, again, equity and debt. Also, I might say preferred shareholders customary have a preference as to distribution of assets in the event the corporation is dissolved. That's what we talked about before. That is in what we call the capital stack, and that is what is the priority of people to be paid off. That is people who have interests. And again, that's what equities really means: is equities are interests in assets, and so who is to be paid off in what order. And if it goes into a liquidation situation, we're really talking about bankruptcy law here. It's a little bit beyond the scope of this course. But I can tell you, definitely preferred shareholders are higher in line in order of liquidation than our common shareholders. And in fact, as I mentioned on Tuesday, a lot of times common shareholders get nothing; they're totally wiped out. GM's bankruptcy back in 2008, 2009, whatever it was, the common shareholders were left with nothing, and that's not uncommon when a company is being liquidated, and even if it's recapitalized through bankruptcy or reestablished through bankruptcy. That sort of thing. So, all right. So, what are the typical rights of preferred shares? Not all these apply to all preferred share issues. Some apply, some don't apply. So, these are not something you can say these are not all uniform features of every preferred share issue. Some are, and some aren't. And so, we'll talk about what some of these are. One is a right of conversion, and that is a preferred share can be converted to common shares based upon some predetermined ratio. We call these convertibles or converts. And that is the idea you take preferred shares and you can convert them to common shares if that is a feature of that preferred share issue. Also, there's a redemption privilege that basically says, okay, we can redeem these shares at any time that we like. And so that's another issue as well. So right of conversion or redemption privilege. The redemption is simply this idea of being able to convert back to common shares if one wants to do that. Now, why would one want to do that? Well, I don't know that it's a real common experience, but sometimes investors would want to convert to common shares because they want to have an interest which is maybe not controlling, but at least gains them a board seat necessarily. And so that may be a motivation. So that's something to think about. Also, preferred shares can be what's called cumulative and non-cumulative. All right, this is interesting because cumulative means if the company misses a dividend, if it's cumulative, they've got to go back and pick up that dividend and pay it in arrears. Okay, so if you have a dividend that's not paid for whatever reason, maybe the company earnings weren't sufficient to make the payment. And by the way, I want to I'm sort of digressing here a little bit, but I know that it's a common perception that dividends are a feature of earnings. And they sort of are. I think the correlations are there. I think there's a lot of academic research that shows that dividends are really a function or a correlation, certainly positively correlated with earnings, but they're not dependent upon earnings. And there are companies that pay dividends that really are independent of earnings. I'm thinking of oil companies, the big oil companies, BP and Shell. And sometimes when oil prices drop very low, earnings are low and maybe negative, right? They're losing, but they're still paying dividends because that's their dividend policy, right? And so the correlation between earnings and dividends is, I think, an association a lot of people believe is stronger than what it is. Okay. In some cases it is, but not in all cases. Obviously, if a company's losing money, you can't lose money forever. And so maybe you do want to, withhold dividends and whatnot. But that's, it really is a case by case situation. So back to the issue of cumulative and non-cumulative. If a company misses a dividend for whatever reason, maybe they did have a bad year and they don't want to liquidate capital, then they will pick it up in the next year, the next year after that, or whatever. But they will pick it up. It'll be cumulative. If it's non-cumulative, it means if you miss the dividend, you miss the dividend. That's it. And tough luck. And no other way to really say it, but the idea that that it is what it is. So, but one thing we should mention, and we'll talk a bit more about this, I think, a bit later, is the fact that with dividend distribution is really a distribution of capital back to owners, usually in the form of cash. There's a cash dividend, or in the form of additional stock, which is less common, but nonetheless does happen. But it's really a distribution of capital to owners. It's not necessarily a direct correlation between earnings in that particular period and dividends being paid out. So I think we should be clear about that. Also, we're talking about participating and not participating. So when we talk about participating, we're talking about the idea that preferred shareholders can receive additional dividends over and above the stated amount, if it allows for that. I don't know how common that is. I would say probably most preferred shares do not have that particular feature as in terms of participating versus not participating. And so I think it's something we should think about there. Okay, equity or debt. Now, I sort of alluded to this a second ago because we were talking about the idea, what is a preferred share? What exactly is going on here, right? Why do we have classes and we have different classes of shares, both common shares and preferred shares. And so what is this big division between common stock and preferred stock all about, right? And when we talk about preferred shares, as I mentioned a second ago, they're really hybrid securities. They're a cross between equity and debt. In my mind, I kind of consider them more debt of the company, that is, than equity, in the sense that there's sort of an obligation to pay dividends. And a lot of companies don't like to pay much in the way of dividends at all, period, whether common or preferred. They probably wouldn't issue preferred dividends if they had no expectation of paying dividends whatsoever. But I think it's got really a lot more connotation with debt. And I think that investors in preferred shares are well, not probably, I think they're definitely more interested in the income stream arising from dividends than they are the appreciation of the stock price, which is not going to be a lot, frankly. If there's appreciation of the stock price, it's going to be to the common stock price because of things like earnings and market share and growth and all that good stuff, right? So but it is a hybrid cross between equity. It is definitely equity. And by the way, the dividends are taxed as ordinary dividends, right? And which are taxed at a lower tax rate than interest or even wages. And so there's a lot of advantages to the investor for this particular. I'm talking about individual investors here, not so much corporate investors, but individual investors definitely benefit from a lower individual tax rate. It's equity because they receive dividends each year, and the company pays dividends. And there's some, strong or weak, whatever the case might be, depending on the company, correlation with earnings. Again, in some cases, the correlation is weak, like oil companies. In some cases, the correlation is strong, where earnings are bad and dividends are also bad, and they may not get a dividend whatsoever. And so that's kind of the way it is. It's also debt because the government is obligated to pay cash at a fixed or determinable rate in the future. In other words, when these preferred shares are issued, they're given an interest rate. It's very analogous to the coupon rate on a bond when a bond is issued. Here, it's not a bond though, and these preferred shareholders are a little bit lower in the liquidation stack when it comes to things like bankruptcy and liquidation and whatnot. So preferred shareholders are a little bit less than bondholders, but they do have rights that are superior to common shareholders. But they nonetheless are equity holders. Okay. And then we talk about mandatorily redeemable preferred shares. There's a liability. And I don't know how common this is. This idea that if we are redeeming these shares, we have to, it's part of the contract itself, the actual issue, then we have to redeem those, and so we'll report this as a liability, which is a credit balance account like shareholders' equity, but it's different because it moves up as a liability, not as a bit of equity. Okay. All right, let's talk about par value. I talked a bit about this a little bit on Tuesday, and I wanted to talk a bit more about what it is. Par value, when it comes to common shares, is really sort of an albatross in a lot of ways. It's sort of an outdated concept, but nonetheless has been around for a very long time. And they are, as your slide shows here, arbitrarily designated to the point where it's like, okay, we're going to issue shares. Now keep in mind, a lot of the stock that's out there trading in the market, you can go into your E-Trade account or your Schwab account or whatever, and you can buy stock. This stock has maybe been issued back in the 1840s, 1850s, when par value was something that was a little bit more relevant to today's situation, where maybe at a $1 par value per share, and anything over and above that was simply what we call paid-in capital. And we're going to talk about how we do the accounting treatment. Today, newer issues may contain no par value. And in fact, I would presume that as we go forward, par value, when it comes to stock, is not going to be really particularly relevant. But it's outdated. So, and you might be thinking, okay, well, stock issued 1840, 1850. Why do we care? Because these shares are still out there and outstanding, and we need to know how to account for them as they're out there. So remember, we're talking about corporate financial accounting from the standpoint of the supply side from the company, and we need to know that sometimes these shares have been issued with a par value. And what par value really represents is something that's, I think, it's sort of an outdated concept. It sort of represented the idea of what a stock could be redeemed for right now if the company were liquidated and whatnot. Today, I think par value really is an extremely outdated concept, but we still talk about it because a lot of big companies have been around for a very long time. I talk about Pfizer; it's been around since the 1840s. Procter & Gamble since the 1850s. Boeing, 100-year-old company. I mean, Ford, General. I mean, we're talking about very old companies out there, and so as a result, some of the stock is still floating around. So we have to understand what par value is and know how to account for it. And it's just one of the things we have to do as accountants is to sort of deal with it. So a lot of shares continue to have this arbitrary amount designated as what we call par, expressed in dollar terms, always as a dollar. And also, I think your text had an interesting discussion of the fact that sometimes in fractions of cents, just because they still want to maintain the whole sort of par value issue. Obviously, we're talking about extremely low dollar amounts in relation to what is often the fair value price per share. Sometimes with nominal par amounts, they become common to dodge elaborate statutory rules pertaining to par value. These statutory rules, I don't want to really get into this a lot because what we're really talking about here is the idea that stock at one time had to have a par value, and this is why we have these shares that were issued. And some states, had different securities regulations and whatnot, and so they would issue a share with a 1 penny par value and whatnot. Okay, and then we talked about this under the Model Business Corporation Act, and par value legal capital have sort of been eliminated entirely from the Model Business Corporation Act. So new shares really don't necessarily deal with this. Older shares do, simply because they're out there. And in the absence of reissuing these shares, they really are still a feature of what's going on with par value. We're going to talk about lots of examples where we have, share reissues, stock buybacks, and whatnot, and we have to account for that par value, that little bit of the original issue that we have to account for. So we'll go from there. All right. So when we talk about dividends, and shareholders' equity of FSU Industries includes $200,000 of $1 par common stock, $400,000 par value of 6% cumulative preferred. The board of directors declared cash dividends of $50,000 in 2021, after paying $20,000 cash dividends in 2020 and $40,000 in 2019. So we're in the year 2021. What is the amount of dividends common shareholders will receive? So you got to kind of think about this a little bit. All right. So we have preferred shares that are outstanding, and let me see here. Are these cumulative preferred? Oh, it is cumulative. Okay, so we have to sort of catch up the dividends. Now, in 2019, the dividend amount was $40,000, right? And what is the amount of dividends common shareholders receive in 2021? All right, so some years we're fine. In this, we have 3 years of scenarios, 2019, 2020, 2021. And so some years we're okay, some years we're not okay. So the answer here is going to be this. It's going to be 22,000 because, and where do we get that number? Okay, so 2019, we have 6% cumulative preferred on 400,000. So 6% of 400,000 is 24,000. So, and in 2019, what was the dividend amount paid? It was 40,000. So we had 16,000 left over to go to common shareholders. Okay. And again, the 16,000 is not like some afterthought. The board knows what they're doing when they declare a dividend. They know they're going to satisfy preferred shareholders, and they know what the yield that common shareholders are expecting to get. So it's not like some, oh, this is the residual, and oh well, this is where the number came from. It is predetermined. However, in 2020, for whatever reason, the amount was cut to 20,000, which means that there's a $4,000 deficit for preferred shareholders. Now remember, common shareholders cannot receive any dividend until all preferred shareholders are paid, whether it's cumulative or non-cumulative in this case, right? Remember, cumulative goes back in time, but non-cumulative means in the year in which it's declared, the dividend is declared by the board, they can't get any dividend at all. So as a result, they get zero, right? And that's not all that uncommon that common shareholders get zero. We saw during the last financial crisis, a lot of companies cut their dividends to practically zero. And the common shareholders were sort of left holding the bag, and then there's nothing they could do. What are you going to do, right? And that's part of the riskiness of stock investing in the first place. So in this case, common shareholders get nothing. But here's the thing: it's cumulative. So as a result, we missed 4,000 of dividends. We would have been preferred shareholders would have expected to get 24,000 in 2020. They only got 20,000. So we need to catch up and get 28,000. That's the 24,000 that we get for 2021, plus the 4,000 they didn't get in 2020. And as a result, 28,000 goes to preferred shareholders. The question is, what goes to common shareholders? And that's the difference between 50,000 that's been declared in 2021 minus what goes to preferred shareholders. So 50,000 minus 28 is 22,000. And that's what goes to common shareholders. If this is the amount of total dividend that is declared. And the dividend declaration is not uncommon at all. It's usually done on a quarterly basis when companies meet. And it's usually not some dramatic event, particularly if the company is very stable and whatnot. Cutting dividends all the way to zero is not terribly common. A lot of companies don't want to do it. And the reason they don't want to do it is because usually the financial community reacts quite negatively and, says, well, if we're not going to get anything from this, we're going to sell it. Particularly if the company is not a high growth company. If it's a high growth company, then dividends are less of an issue, and it's more a question of, is the company earning money long term? Think about some of the high tech companies that are out there that pay very low dividends. Apple, Nvidia, and whatnot. They don't really pay much of a dividend, but shareholders are okay with that because of the fact that the stock price keeps growing because the company just is growing in terms of earnings and strength, and their equity position, that is the ownership position, only gets stronger over time. Okay. All right. So, any questions about this dividends and arrears issue as it concerns preferred shareholders? Okay, so we're going to talk about shares that are being sold here. So we've got some examples where the company might sell some of its common shares, and we're going to talk much more about this idea of selling shares and also buying back shares. And there's been a lot of discussion about share buybacks in recent years. But in this case, what we're talking about here is that they've got 10 million of its common shares, dollar par value, and $10 per share. So $10 per share times 10 million is going to be $100 million. And so obviously 100 with 6 zeros omitted, $100 million goes to cash. We're going to credit also the common stock account because in this case, this is the par value amount, right? That's $1 per share times 10 million. And so it's 10 million shares is 10 million. And then what we call paid-in capital in excess of par. This is where we're selling shares back to the public. And it happens all the time. And I would have sort of preferred this come a bit after the stock buyback issue, but nonetheless, I'm sort of taking these in the order in which the text presents them. But this is not terribly uncommon where companies will sell back shares into the public and in the public market and receive cash for them. And if there's demand for them, then they'll be snapped up at whatever price the market determines the fair market value to be per share. If there's no demand, then they won't sell them. Or if there's a weak demand, maybe they don't agree to the price. Remember, companies don't have to sell any particular price whatsoever, and nor do individual investors. If you want to sell something and nobody agrees to that price, there's no sell and there's no sale that's necessary. Okay, if there are no par, though, the transaction is much simpler. And it's simply $100 million cash and common stock, 100 million. Okay, pretty easy. So debit, cash, 100 million, credit, common stock, 100 million. The only difference is if there's a par value attached to it, which was attached to it back in its original issue, whatever the heck that was, 1880, whatever, then you're going to have to account for the par value. This is not really that huge of a problem because the difference between those is simply this guy here called paid-in capital in excess of par, right? What we call the PIC account. It's simply a way to plug the difference between the par value, which is a notional and a nominal amount. It really has no bearing whatsoever on reality, particularly if you're 150 years down the road. What the heck does a $1 per share even mean? But we have to sort of account for it somehow. So we use this PIC account, paid-in capital. And we're going to see this both with a debiting or a crediting, whatever the transaction is. Paid-in capital will be this amount that we use in order to make this transaction balance. Now, by the way, one thing I'll say about paid-in capital is the idea, it kind of goes to this overall notion that we have really two forms of equity capital, ownership capital. Paid-in capital that comes from owners, typically outside investors. There could be inside investors that, managers and whatnot. But nonetheless, it all goes in sort of big bucket of paid-in capital. And there's also earned capital, which is, typically we call retained earnings. And I think I'm going to defer retained earnings to my discussion more on Tuesday. But those are the two broad categories. And so paid-in capital is simply the amount received from investors, and it's often dominated by outsiders, people who don't own the company, don't have any connection to the company in terms of management or any other connection, employment relationship, whatever the case might be. And this is a very common feature of equity ownership of companies, is the idea that outsiders really have no real direct control. They're simply investors. Now, they may get a seat or two on the board, and that's something that is more of a corporate governance issue that may come up a bit later for those of you who are going to study for the CPA exam. But for the most part, when we talk about paid-in capital, not just paid-in capital as a plug value here, but paid-in capital as a category. We're talking about outside investors putting money into the company for investment purposes. Okay. For whatever they expect to get out of it, they expect to gain, and whether it's through dividends or whether it's through capital appreciation of the stock itself, or both, right? So all can be considerations. All right, so that's an example of selling shares for cash. Also, there is an issue where we could sell shares. The company in this case, the share issuing company, could sell assets for non-cash. Whatever the case might be, I don't know how common this is. It's probably not real common, but they could issue them for whatever. Maybe it's from services or whatnot. They could swap stock for whatever. I don't know that it's not common, I don't think, but it's not unheard of. And I know that sometimes companies will want something from some other company, and they'll just simply do a swap where they're given shares for whatever the consideration is given. Consideration, obviously, going back to business law, is simply some sort of value given in exchange for something else. But a contract, theoretically, at least, should have an equal balance of the value of consideration in both directions, right? And so, as a result, it could be for legal services, and that could be one thing. It could be consulting services. It could be other goods. It could be equipment, whatever the case might be. And so, as a result, it's simply a swap of one asset for another, and shares go one direction, and the asset goes the other direction. And so, as a result, we have a transaction. Okay. And the issuance of shares should be at the fair value of whatever the value of the consideration that's being received ought to be, whatever it is, whether it's land, real estate, whatever the case might be. It ought to be consistent with the fair market value, and so as a result, the transaction should be considered a balanced transaction in this case. Okay. Also, non-cash consideration. Here's an example. DuPont Chemicals issues million of shares of its common shares, dollar par per share, in exchange for a factory that's already built with no cash price available. All right. Now, this is interesting, and we run into this occasionally, and it's one of these test cases which we get into in intermediate accounting and also in advanced accounting, where we say we don't really know what the heck the value of this thing is that we're acquiring, but we know the value of the thing we're giving up. And so, and I know it sounds completely crazy, but sometimes you just don't really know what the value of something you're acquiring is. And so, what do we do as accountants? We have to value what's being given up. And so, in this case, there's no list, for it. So, the quoted market price of the shares might be the best evidence of fair value. I underline this, right? We don't know what the value of this property, plant, and equipment is. And so, if we've agreed that this is that $10 million that's being given up is the amount that should be forked over for the property, plant, and equipment, then 10 million it is, right? So as a result, what do we have? Well, we have common stock that we're going to give. Now it has a par value, so as a result, common stock. And by the way, the par value is simple. This is common stock, $1, which is $1 per share, right? And it's a million shares, so 1 times a million is going to be 1 million. We chopped off 6 zeros, and this 10 million is the transaction value. So the other 9 million is paying capital in excess of par. And that's the way that we balance that transaction. So we're reducing our equity position in order to acquire the asset. So we have debit to the asset side, whatever it is we're acquiring, and credit to the to this side here. Okay. Okay, so that's essentially what's going on there. And again, there are transactions which the value of the asset being acquired or the assets, whatever the case might be, are really hard to sort of get one's arms around. But nonetheless, we have to do our best. Okay. All right. When we talk about more than one security issue for a single price, it's usually the sum of separate values of the two securities. Again, intermediate accounting, we give it a lot of different methods, a lot of different scenarios, some of which I will tell you right now, you're probably never going to come across. I just am going to be honest with you. And this is probably one of those which, it may come up, it may not come up, but nonetheless, for those of you, a lot of our students are CPA prep students. This may be a CPA exam question, in which case we need to cover it. So what's going on here? So it's cash received, and it's usually the sum of two different securities in the aggregate market value of those. And so if only one, and to make matters more complicated, if only one security's value is known, the second security's market value is inferred. In other words, it's the difference, it's the residual of these. And so we simply allocate the selling price between those two security issues because we really don't know. We know one for sure, but we know the other for sure. And so this is kind of like algebra on steroids here, but it's applied to finance in this case. And so here's what we got. So APP issues 4 million of its common shares with $1 par, okay, at the time of issue, whenever that was, and 2 million preferred shares, $5 par for 100 million. And in today's issue of the Wall Street Journal, which I don't know, there are different ways to get quotes. The Wall Street Journal was typically the go-to source, but we can get them in real time on your phone and whatnot. So the common shares are $10 per share, and there's no established market for the preferred shares. All right, so we know we're going to get 100 million. So we're selling something, and we're going to get $100 million in cash. The question is, how do we account for the exchange of shares that go the other direction, and what do we do about it? So in this case, we have common stock. And it's 4 million and $1 par, so 4 million, and then the remainder of that is going to be $36 per share. Okay, 4 million shares, and the preferred stock. And by the way, this is the residual of this because the preferred stock. I'm sorry, and this is where we get the common stock value, right? So 4 million shares, $1 par, and we know it's $10 per share. So at $1 par, 4 million shares. 4 million times 10 million is 4 times 10 million is going to be 4 million, and we're going to get the residual there. The preferred stock has no market value, so it's got to be the residual. We've got to get our way to 60 million. In this case, we have 2 million shares at $5 par. That's going to be pretty well established. And then the plug number here is the PIC account, paid in capital, excess of par on the preferred shares. Why are we doing this? What the heck is going on here? This sounds like a completely crazy transaction. Well, first of all, we know the value of the common stock, right? And again, it says the Wall Street Journal, but it could be, anybody. You can call your broker, you can look it up online, you can look it up on your phone or whatever. Usually it's the closing price as of a certain date. And if the stock price, fluctuates wildly after the deal is done, there's usually some provision to deal with that contingency. But nonetheless, the idea is we know we have 4 million shares going on here. At $1 par is going to be 4 million. To get to the 40 million, which is $10 per share, 40 million is going to be 36 million here. And the preferred stock is going to be the balance of 100 million minus 40 million, which is going to be 60 million. This part's easy because we have a par on the preferred stock, 2 million shares. Where is it? 2 million shares at $5 par, 10 million. So it's got to be the paid-in capital is going to be 50 million. That's the way that we balance this transaction in order to make it happen. Okay. And that's really all that's going on here. When we don't know the facts, how common this scenario is, I don't know, honestly. I have been a longtime follower of business news and stock transactions, and this is probably not all that uncommon, but as an everyday occurrence, no, probably not. All right. Okay, so questions about this issue where we have more than one security issued for one single price, where the company issuing it, they're going to issue stock and they're going to get cash in return. Okay. Okay, all right, let's go to the next issue here that we're going to talk about, and that is the idea of issue cost. And and when we talk about issue, we're also going to talk about buybacks. And so we're going to really cover two important topics that are related sort of in reverse, and that is the idea of issuance of stock and then buying back of stock. And it's the buying back of stock that I think is probably the most compelling story at the moment, because there's been a lot of buybacks in the last few years. But before we get to that, though, let's get into share issuance costs. And this is something that really is sort of independent of the news and whatnot. It's just simply the way companies do business and when it comes to issuing shares. And so in this case, in 2018, Avexis sold 4 million of its 1/10,000th of a dollar par value common stock at $102 per share. Again, very, very, very small dollar figure for par value. And for the public offering of 431 million after deducting underwriting discounts and commissions and other offering expenses. Okay. And obviously, when you're talking about going public, taking shares public, you need to work with an investment banking firm that takes these public, and they work their markets and decide, try to get these things sold to investors, many of them institutional investors or anybody else, right? And as a result, that's the transaction that goes on. And the underwriting costs are simply the cost of putting together the financing package. And all the legal documents and all the filing with the SEC and all this other stuff that goes in underwriting. This is what investment bankers do when it comes to issuing new shares. And so in this case, 431,857 are the amount of proceeds, and net of underwriting discounts, commissions, other expenses, a lot of legal and accounting expenses, a lot of legal and accounting expenses are often attend these particular transactions. And so as a result, we take this dollar figure here, 431,857, and put it in cash. Remember, we're selling shares. We're selling shares of our company to the public. So we're going to debit cash, and we're going to credit common stock. Remember, common stock is going to be a credit balance account. Okay. For 0.0001 of these shares, and that's going to be 451 million. And the remainder is simply paid in capital in excess of par. And this is where there's par value on a stock issue. They're going to have a paid in capital account, right? Which can go up and go down. If we sell stock, we sell some of the stock back to the market, we buy more shares, whatever the case might be. If it's this particular issue, we're going to have this particular PIC account paid in capital. Okay. And we're going to reduce the cash proceeds by, well, we did not include here, and we probably would in a more advanced accounting courses, where we'd include specific underwriting expenses, investment banking fees, legal fees, accounting fees, and all that. Here, we're just simply netting it out, and we're simply saying this amount here is net of all this stuff that we had to pay for professional services, banking fees, underwriting fees, accountants, lawyers, whatever, all that kind of stuff would go into that. Okay, so that's an example of how we simply handle the transaction. Remember, the key thing is the par value, is this guy here, and then any residual over and above the amount of the proceeds from this issue then go to the PIK account, and that's in excess of par. Okay. Okay, and so here's an example. Beamer Company issued 50,000 shares of 1 penny par common stock for $230,000, which the following will Beamer record as part of the journal entry for this transaction. Okay, well, there's a lot of different elements to talk about here. There's only one that's really going to work, and that is this idea, and I think we're going to sort of go to this issue of the par value, the credit to common stock for $500. 50,000 shares times a penny per share is going to give us $500, not 500 million, $500. And that's going to be the common stock account, right? So common stock, really, when you see common stock as a line entry on a balance sheet, it's really the amount of the par value. And anything over and above that's going to be the penny capital in excess of par, which is often going to be many, many times larger, simply because of the fact that we're paying more, the market's paying more, the par value is sort of a nominal amount, whatever the case might be. And I think some states, sort of still adhere to par value and whatnot. I think par value is probably going to be eliminated at some point, just because of the fact that it meant more at one time than what it does now. But we still have to account for it if it exists. In this case, this is new issuance, and so we do have to account for it. Even though it's only a penny per share, we still have to account for it. And the majority of the capital stock value here is going to be paid in capital. But it's nonetheless, how is it really different in terms of value of the company? It's not really that different, right? It's just the way we sort of categorize it. So we still have $230,000 in cash that we received. And we don't know the terms of the transaction, whether there's a dividend attached or whatever. All we know is we get $230,000 cash, and we're going to divide it based upon this sort of legal distinction between par value and the rest of the issue value itself. Okay. And by the way, the price of these shares is oftentimes different. This is why investment bankers are necessary in order to establish what the price of these shares ought to be in the market. Doesn't mean they always get it right. And I think one example, Facebook's public entry into the market. Facebook, obviously now called Meta, had a kind of a rocky and a weird, in my mind, kind of a weird, public offering where the stock was probably not priced correctly, and there was a lot of consternation about that. And obviously, it's since recovered; it's gone up in value. So anybody who's held at that time is not really complaining. But the idea is that this is why we need the expertise of investment bankers to know what the value of these shares ought to be worth. And there's a lot of other issues. We could do semesters and upon semesters dealing with things like public offerings and whatnot. And as I had some experience with this, mostly in the bond market, however. So we're sort of verging into the finance area. So there's only my expertise here is going to be somewhat limited in some cases. Okay. All right. So questions about issuance of stock and what we're doing here. And companies will take shares public for all kinds of reasons. It's a way to raise capital. It's a supplement to everything. By the way, equity capital is a good buffer because common shareholders in particular don't have to be paid anything at all. And so if you're a common shareholder, you got to kind of know what you're getting into. And this is why the stock market is something that requires research. And it's not as simple as going down the street and buying Pop-Tarts. It's a complicated situation. And so this is why the investment community has lots of professionals to sort of help ordinary investors understand what's going on. When it comes to institutional investors, they're sort of on their own. They're assumed to know what they're doing. Okay. All right. So we talked about issuance. Let's talk about repurchases. And this is an interesting topic. I mentioned this a few minutes ago, and that we've been seeing a lot of this activity in the last several years. That is, companies that are buying back their own stock. This is stock they've sold to the public, and they're now going to buy it back. Now, why in the heck would you do that? Because the transaction is this: you you debit, whatever the stock is, preferred share, often it's common shares. So you debit common stock and any penny capital, and you credit cash. You're reducing the value of the firm. So why the heck would you want to do that? Well, there are a lot of reasons why companies want to do that. And we're going to get to these. And because it sounds like if you knew nothing about the current environment, you might say, well, this is really ridiculous. Why would a company want to do that? They're giving up some of their own cash, and all they're doing is giving away stock to somebody, or they're buying back the stock which is already out there. In other words, it's really an internal transaction between the company and shareholders themselves. Why would you want to do that? Well, let's talk about that, because it's an important explanation, and it really explains a lot about what's been happening lately. So, but let's talk about what the basics are, the mechanics are of the transaction. It's a way to distribute profits without paying dividends, first of all. And this is an important explanation for what's happening. So dividends are taxable to shareholders. Now, there are a lot of areas in which owning stock, and I'm not talking about the company here issuing stock, I'm talking about people owning stock, people, companies, whatever, how they get compensated. One way they get compensated is dividends, but dividends are taxable, so they got to pay tax on it. Now, obviously, it's taxed for individuals at a lower tax rate than ordinary income usually, but nonetheless, they're taxable. Or you can reward shareholders by rising stock prices. And by the way, if you think about people like Warren Buffett, a lot of his wealth has never been taxed. Not because he's up to no good, it's because of the fact he's held on his shares for decades and they've gone up and up and up. And you don't pay tax on anything that you had sold. And despite the fact that President Biden wanted to sort of introduce a tax on what are called unrealized gains, that was never happened. It was really it was a doomed initiative from the start. But the idea is that a lot of people have had stock for many, many, many years, decades, and have never paid tax on it. So that's another way of compensating somebody, is the idea you can raise the value of their holdings without incurring any taxable event. Okay, so I focus on the tax issue a lot. I know that I'm a tax guy, so this is kind of my sort of orientation. But nonetheless, we need to discuss the fact that there are different ways of compensating shareholders and rewarding them for their ownership and encouraging, their continued hanging in there. We don't want people to dump all the shares because they'll take the stock price. And by the way, a lot of insiders also own stock, and so they have a vested interest. As CEO, CFO, and other insiders, they've got and board members have got a vested interest in keeping the stock price up. Okay, so that's one way. So you can pay dividends, you can simply grow earnings. But what if you can't grow earnings, right? And so another way to do it is simply by buying back shares. What you do is then you make the shares more scarce in the market, and there's no effect on earnings because there's no operating effect whatsoever. It's simply, I'm paying cash, I'm the company, I'm paying cash for shares that are out there. I'm bringing them back in here, right? And I'm making less shares out there in terms of what we call the float. That is the authorized shares minus the issue. Well, there's authorized shares, there's issued shares, right? It could be a different math. So we can authorize at the time of capitalization, incorporation, 1,000 shares. We issue 600, and we want to buy back 100 shares, okay? So 500 shares now the float. We have reduced that. And by the way, what does that do? It also boosts return on equity. Why? What is return on equity, which is a pretty key metric in terms of stock or company profitability? And that's simply net income, usually after tax, divided by stockholders' equity. If stockholders' equity has gone down, in other words, the denominator has gone down, and this ratio is going to pop up. So as a result, it's going to be a positive to that effect, right? And also, if their shares are more scarce, the stock price is probably going to go up. And we've seen lots and lots and lots of share buybacks in the last few years. And I know that in the previous administration, President Biden was really, really against the idea of stock buybacks because, frankly, companies were sort of awash in cash after the huge tax cut they got beginning of 2018. And so they didn't do something with it. And by the way, companies can't just hoard cash and assets. They've got to sort of distribute it. And it's also a tax issue where the government wants to tax the owners somehow for those earnings. And so So companies have had to find ways to do it. And I know that as part of the Inflation Reduction Act, there was a small tax paid on these stock buybacks, and I don't know honestly. I wish I had this information as to what happened with the new tax bill that was just passed over the summer, but as to whether or not that was repealed, I suspect it was, but I don't know for a fact. But I can tell you for sure that the government's really pushing back on this. But it was a losing battle because companies really had the incentive to buy back stock, and they were doing it in huge amounts. And I had a slide I could probably dig out here somewhere. I used it in my Principles One course about the huge amount of buybacks that have been going on. So companies buy back in order to sort of boost return on equity, make the stock price go up, and again, not to sound cynical, but a lot of insiders want the stock price to go up because they're also owners themselves, right? Whether it's top officers, board members, all these are shareholders, and they want to do whatever they can to raise the stock price. And there's nothing operating involved here. They're not investing in new products necessarily, or whatever. It's simply a financial manipulation, and not the right word, financial maneuver, I should say, that's intended to reward shareholders, and companies have been doing it a lot. So in this case, we have a sort of an example of a note to financials. I don't know what company this belongs to. Our board of directors has approved a program to repurchase shares of our common stock to reduce the dilutive effect of our stock option and stock purchase plans. So we'll get to this a bit later, this idea of stock option and stock purchase plans, which a lot of times companies engage in order to compensate people. Dilution represents this idea that the more shares are out there, the more one's interest, the percentage interest, ownership interest goes down. And so as a result, anti-dilution policies seek to sort of reverse that in the other direction. Most investors don't necessarily care about dilution unless they really have an interest in getting real stake in what goes on with the company. We've seen activist investors out there who want to buy big positions in companies, and they don't want this dilution because it waters down their ownership and whatnot. So, and again, we're sort of verging on finance here, and so I don't want to get too far into this, but if you have questions about it, feel free to reach out to me. I'm more than glad to talk about it. Okay? All right, so this is a kind of confusing slide here. This is not my favorite slide in the whole thing, but the idea that we have shares be required in we can do this. We can do a stock dividend, a proposed merger, defense against a hostile takeover. Now, by the way, why would a company want to do a defense against a hostile takeover? So a lot of companies do not want to be bought by somebody that is a hostile buyer. So they might buy their own shares back so as to make those shares more scarce, and then that would therefore make it more difficult for some other party to buy the shares in a hostile takeover. We don't see hostile takeovers all that much anymore. I don't think certainly when I was early in my career, we saw lots of hostile takeovers, and in some cases, the government sort of stepped in to say, all you're really trying to do is manipulate the stock price, where you're claiming you want to buy the company and you really don't, and you want to simply be bought off by the company, and so-called green mail. But nonetheless, it is an issue where if a company does not want to be bought, they'll buy back their own shares, thereby reducing the so-called float as the number of shares out there. And and you can't take ownership of a company if you don't have those shares. And if there are fewer shares out there, then they won't fall into so-called hostile hands. There was a company I worked for, this is probably 30 years ago, where it was about 51% owned by a family, and they wanted to divest some of the assets, and they went below 51%, and they got very scared about the fact that there was going to be a hostile takeover, so they started rebuying shares in order to prevent that from happening. And it was a public company, but they were getting a bit nervous about that because they did not want to lose control. And when we say one family, we're talking about the family and all the tenant relatives and the subsidiary companies and all this and whatnot. So they wanted to maintain that control issue. And obviously 51% of the shares will do that. And nobody can do anything about it, right? Unless you issue more shares. In which case, maybe you want to buy those shares as well. So again, there are a lot of different elements to this. All right, so what about stock buybacks? How do we hit? This is really the most important piece of this, and that's we can retire the shares altogether, which I don't think is necessarily advisable, or we can book it as treasury stock transactions, which are going to be contra equity transactions, at least on the equity side of the transaction. That is, we credit cash and we debit treasury stock. Obviously, debit to equity is a contra equity account. We can retire them, and I think your text gets into this idea of why maybe retirement is not all that advisable. And I think that here we're talking about retiring shares. We're simply saying these shares are no longer going to be available. They're out of circulation and they're done. And I think, and I don't know, I'm not an attorney, but I think if you do that, you probably have to go back and refile or amend the corporate charter or file something with the Securities and Exchange Commission that says, okay, we're going to bring these shares back. I don't really know, but I think that the left side here probably doesn't make a lot of sense. The right side, treasury stock transactions, make a lot of sense. And by the way, companies can buy back stock because they think the stock is undervalued in the market. We saw this happen a few years ago where Apple said, hey, our stock is undervalued and we're going to start buying our shares. Boom. Now they did a couple things with that, right? They were buying back stock, and so it meant fewer shares out there. Nothing changed with regard to net income and operating performance and market share and all these business attributes, but they were simply shrinking the number of shares out there. And by doing that, also just the fact that demand for shares boosted the stock price itself. And as a result, sometimes companies can buy low and then later sell high. They can sell this stock back into the market. We don't book it as income because it's a transaction that's considered to be in-house between, because owners are really part of the company itself. They don't have operating authority, but we can sell them back in the market itself and book a gain in what's called net assets. And that's a strategy that companies may do when they find or feel that their stock is undervalued. And who knows what the value of stock is or should be. This is why stock prices fluctuate. I mean, stock prices are up, they're down, they're up, they're down. And if something had an objective value to it, we wouldn't have really a need for markets and buyers and sellers because of the fact that it would be an established price. But that's not the way it works, right? It's the interactions of buyers and sellers that determine market price. And so, but in this case, if the company issuing the stock feels the market is not reading it correctly, they're not seeing things correctly, and so therefore they buy back some of their own stock in order to do that. And Apple's far from alone in this particular example. So, all right, so let's talk about this comparison between retirement and treasury stock accounting. So we're going to do a little bit of this. We got about 9 minutes left. And so American Semiconductor's balance sheet included the following. This is before the transaction that we're going to be seeing here. This is before the buyback. So this is the right side down low shareholders equity section of the balance sheet. Common stock, 100 million shares, $1 par is 100 million. It's 100 million times dollars, 100 million. Paid in capital excess of par, paid in capital for a share repurchase, and then retained earnings of $2 billion in this case. And then what we're going to do is American Semi is going to repurchase a million of its common shares. Not $1 million, but 1 million of its shares. So what is going on here? What are we doing with this transaction? Okay. So there are two possible scenarios. Okay. There are two scenarios. And the case one is where we'll retire the shares. We're going to say, okay, these shares are no longer ever going to come back on the market, and we're going to simply put them away, and they're no longer going to exist. So we reduce the first of all. So what is the transaction? We got to go back to what the initial transaction was. 1 million of its shares, and all right. So and they're going to be repurchased at $7 per share. Okay, which is, by the way, a little bit less than what it's currently trading for. So common stock is going to be debited, right, to reverse the par value. 1 million shares times $1 is going to be $1 million. We chopped off 6 zeros here. The paid in capital excess of that is going to be 9 million. And the cash is going to be 7 million. That's 1 million shares times 7 million. And again, we're taking out, we're not including any brokerage fees or whatnot, which would definitely be part of the transaction, I think, at this big of a level, but we're going to assume that doesn't exist. and we're going to have cash 7 million. That's a credit to cash, and then a credit to balance. We're reversing the paid-in capital for the share repurchase. Okay, and that's simply saying these shares are going to go away. Now that seems like a little bit lengthy, a little bit tricky, and maybe, I don't know, nonsensical, when you could simply do a treasury stock transaction that says, we're going to buy 1 million shares of our stock back. 1 million at $7 per share is going to be $7 million bucks. Boom. Same deal here, but all we do is simply put treasury stock, which is a contra equity, and we're simply bringing it back into the treasury. The treasury does not refer to the U.S. Treasury, it refers to the company treasury. We're simply buying these shares back, and that's all it is. They're still authorized, okay? They're still out there. We can reissue them. They're not part of the float necessarily because they're not out there. We simply put them to bed, and maybe one day we'll reissue them, particularly if the stock price goes something significantly above 7, right? Which is, again, one of the motivating factors for a board to say, okay, we want to buy shares back because we think they're undervalued. And that's not an uncommon scenario whatsoever. And I would love to tell you that the stock market is rational, and it always has the right price, but I've been at this game for so long that I think that sometimes the market has got things a little bit wrong at times. And so I can well understand management's point of view that says the market is nuts, at least in the short run. And so we want to sort of buy back these shares right now, among other motivating factors that they want to do. All kinds of issues where maybe they want to prevent a hostile takeover, maybe they want to, reward shareholders with lower shares outstanding, number of shares outstanding, to reduce the float, boost the price, and buying back stock tends to increase the price, and that's one way to reward shareholders on a tax-free basis, assuming they hold the shares as the share price goes up, assuming what we call ceteris paribus, Latin term meaning if everything else is the same, earnings are the same and all that, it's a way to reward shareholders for doing that, okay? All right, so another example here I'm sorry, this is the same, no, it's a different example, isn't it? So, case two, shares repurchased $13 per share, retirement and treasury. This is a different example, right? It's kind of strange the way these are ordered here. So remember, retirement versus treasury stock. Treasury stock, very simple. We're repurchasing shares at $13 per share, credit cash, debit treasury stock, boom. Otherwise, if we're doing a retirement where we're putting the stock to bed, we got to go all the way back to the par value. Remember, the common stock account title refers to the par value. So it's $1 par times 1 million shares, which is 1 million. We dropped 6 zeros off. Paid-in capital excess of par, paid-in capital share repurchase. All this sort of balances out, and so as a result, we have the balanced transaction. One is retirement, the other is a treasury stock transaction. Okay. All right, and we're very close to sort of getting to the end of what we can do today. And again, I'll pick a lot of this up on Tuesday and talk more about it. But I do want to talk a little bit about this idea of what's going on here with regard to treasury stock. So when we talk about purchasing treasury stock, it's really a reduction, and I like the word temporary here, a reduction of shareholders' equity. So think about what the accounting entry is, and we can kind of go back here just to kind of show you what it is. It's a reduction in the value of the firm, right? It's let's take this example. We're paying $13 million, so we are losing $13 million of cash, and we're reducing the shareholders' equity by $13 million. So we're reducing the value of the firm, right? And it's a reduction of shareholders' equity, but it's temporary in the sense that we can theoretically unwind this and maybe do it at a higher price than what we bought the shares back in the first place, and which we don't call net income. We just simply call an increase in net assets, right? So we're saying it's temporarily debited to the treasury stock account, but they're still considered issued but not outstanding, right? Issued means they're out there, right? Which, remember, we have different categories, and this goes back to principles when we have authorized shares, which may be a far larger number than what's issued. We have shares that are issued, and we have shares that are outstanding. Well, these are shares that are issued, but they're not outstanding. They're not part of the float itself. And so as a result, they're not out there. And so, and we refer to this as a single transaction. This is a little bit of a misleading term, frankly, but I get what's going on. All we're doing, if we are selling them later, is we're simply unwinding the original repurchase of that stock. So I don't know, the term single transaction is a little bit misleading, but nonetheless, the idea is all we're doing is simply rewinding, preferably from the company's point of view, the issuing company's point of view, at a higher price than what the purchase was done in the first place. And that's good news for them because it's an inflow of equity as opposed to an outflow. So, and we're talking about the cost method. Simply, we're talking about at the cost in the current market price. And so, we're not buying at some special price. We're buying it from the market itself. We're going into the market and buying shares back at whatever the current market value might be. And it's oftentimes not one transaction. It's a series of transactions done over time, maybe several weeks, months, whatever the case might be. And they'll sort of take the prices given and they'll go from there and all that. So one final thing, because we're almost out of time, is the balance sheet effect, because this is really what's important here when it comes to this issue of shares going up and down in terms of outstanding numbers. And so any increase in net assets is going to really, what does that result from? The sale or subsequent repurchase. If it results in net increase in assets, it's going to be a larger increase in paid-in capital, okay, which is an equity account. It's part of shareholders' equity, right? Just like owners' equity in the proprietorship. Any decreased assets is going to be a reduction in retained earnings. And this is where I think we're going to stop, because what's going to lead us into the next area that we have not yet covered in Chapter 18, and that deals with retained earnings. And we're going to talk about that. So, but we're out of time, and we'll get to that a bit later. We're not quite to the retained earnings piece. I've got a little bit more work to do here, but I will cover this beginning on Tuesday and talk more about what's going on there with regard to that. Because we've covered common stock, preferred stock issue, stock buybacks, and whatnot, and there are a lot of other areas with regard to stock issues, things like stock splits and whatnot that we're not really going to cover. It's not really that relevant to what we're doing, but we are going to cover a bit more of the issue of what retained earnings are all about. And retained earnings are kind of like the corporate savings account over time. Okay, that's obviously not a very rigorous way of defining it, but we will talk more about that. Okay. All right. So have a great weekend. If you have questions about anything regarding anything that's happening, if you need a little more time to work on Chapter 18's homework and quiz, let me know. I'm available, and I'm more than happy to do that. And we can set a day for that to happen. Otherwise, I will see you all next week. Have a great weekend.